Welcome back. Let's cut straight to the point. If silver were truly just another industrial commodity, if inflation were easing, and if the financial system were as steady as advertised, then how do you explain this? A market where silver rockets 10% higher day after day, where buyers are locked out and sellers are frozen, where the exchange itself slams the brakes repeatedly. That's not stability. That's not a healthy rally. That's a flashing red signal. For years, the silver trade has been marketed as transparent and efficient, a clean reflection of supply and demand. But what's unfolding now exposes that story as a facade. The constant use of limit up, halts on COMEX isn't protection. It's proof the system built to restrain silver prices is buckling. Price caps don't exist in markets that function smoothly. They appear only when natural demand threatens to reveal truths the system doesn't want exposed. Each time silver hits those limits, it's a sign that genuine demand is overwhelming the paper structure designed to suppress it. Instead of letting prices adjust naturally, the exchange freezes trading, delaying the inevitable. That doesn't fix the imbalance, it only kicks the can down the road. Futures were meant as a hedging tool, not a speculative casino. Yet over time, contracts multiplied far beyond physical supply, creating a paper market detached from reality. As long as traders settled in cash, the illusion of abundance held. But once confidence erodes and participants demand exposure tied to actual metal, the cracks can't be hidden. Limit-up sessions don't show retail panic, they reveal systemic stress. The exchange halts trading because it fears disorderly repricing, and that fear is justified. A truly free silver market would expose how undervalued the metal has been for years. Instead, mechanisms are deployed to restrict participation, not to allow honest price discovery. Supporters claim these controls prevent volatility, but volatility isn't the problem, distortion is. Suppressing natural moves builds pressure, turning what should be a gradual climb into explosive breakouts. Every locked session reinforces the truth. Current prices are artificial, sustained only by intervention and fading confidence. History shows that controlled systems always fracture. Governments capping prices create shortages. Central planners spark black markets. COMEX is no different. By limiting price movement, it signals that supply at current levels has evaporated. Sellers refuse to part with metal they know is undervalued, while buyers grow more aggressive, sensing scarcity. This isn't a glitch. It's the collision of years of monetary excess with physical reality. Silver isn't surging because it suddenly became more useful. It's surging because the currency measuring it is being debased. Futures can delay recognition, but they can't erase it. Price controls can muffle the signal, but they can't change the message. Eventually, pressure overwhelms the system. Either prices are freed or trust in the exchange collapses. And once trust is gone, paper promises lose credibility, while real assets command premiums no rule can suppress. Breakdowns don't happen overnight. They build slowly, then erupt. Each limit-up day is another crack in the dam. When it finally bursts, silver won't reprice gently. It will reprice violently, reflecting years of suppressed demand and monetary mismanagement. This isn't just about silver. It's a case study in what happens when financial engineering replaces honest markets. Exchanges can pause trading, widen limits, rewrite rules, but they cannot manufacture trust. And once trust evaporates, control is powerless. For decades, silver's abundance has existed mostly on paper, futures, swaps, unallocated accounts, all creating the illusion of endless supply. That illusion holds only as long as participants are content trading claims instead of metal. The moment the market doubts those claims can be honored, the gap between paper and physical becomes undeniable. Paper silver was never meant to replace real silver. It was a tool for hedging, but contracts multiplied far beyond deliverable supply, relying on the assumption that few would ever demand the actual metal. As long as confidence held, the system looked stable. But physical silver plays by different rules. It must be mined, refined, transported, and stored. And when reality collides with paper promises, the truth can no longer be ignored. Exchanges don't slam the brakes because everything is stable. They do it because allowing prices to move freely would expose realities that those in charge want to keep hidden. A frozen market signals urgency. Buyers are eager, sellers are retreating, and the imbalance is so extreme that normal mechanisms break down. In a healthy environment, prices shift naturally to restore balance. In a stressed one, that adjustment is feared, so it's delayed with rules, limits, and halts. But delaying doesn't ease the pressure, it intensifies it. Restrictions are always the first sign of systemic strain. When confidence is strong, markets stay open and liquid even in volatile conditions. When confidence weakens, liquidity vanishes first. Traders realize they may not be able to exit later, so they rush to act now, amplifying the instability that controls were meant to prevent. Locked markets also reveal how dependent modern finance is on leverage and trust. Much of today's activity rests on borrowed capital and paper claims. That structure only works when participants believe they can move in and out freely. Once that belief cracks, leverage flips from advantage to liability. Margin calls rise, positions collapse, and fragility spreads quickly. Authorities justify halts as investor protection and orderly trading. But order imposed from above is not the same as order created by genuine market forces. Artificial stability masks risk instead of resolving it. By freezing activity, exchanges trap participants in positions they no longer want, turning paper losses into real ones. That isn't protection, it's containment. History shows the pattern clearly. Price caps create shortages, capital controls create black markets, and trading halts erode credibility. Once investors see rules can change mid-game, they begin to doubt the integrity of the system itself. A locked market also sends a message to outsiders. Access is conditional, not guaranteed. That realization shifts behavior. Investors who once trusted liquidity start seeking assets that cannot be frozen or rewritten. Capital flows away from paper instruments toward things outside the system's control. At its core, a locked market reflects institutional fear. Regulators and exchanges know that full repricing could trigger broader consequences. Prices don't move in isolation, they mirror deeper economic conditions. A sudden, uncontrolled surge in one market can expose weaknesses across balance sheets and currencies. By halting trading, authorities try to contain the problem, but interconnected markets don't allow stress to be quarantined forever. Distortions build quietly through easy money, excessive debt, and financial engineering. Risk is mispriced, volatility suppressed, and calm appears to reign until something breaks. Locked markets mark the moment suppression shifts to panic management. Each intervention erodes trust. Traders remember being trapped, unable to act. Next time stress emerges, they react faster and more aggressively, accelerating the cycle. Liquidity dries up sooner, controls multiply, and markets lose their ability to self-correct. That's why locked markets aren't isolated glitches, they're symptoms of a deeper illness. They reveal a system stretched beyond its limits, sustained by confidence rather than fundamentals. Once confidence falters, the tools meant to hold it together lose effectiveness. Rules can be tightened, limits widened, trading paused, but none of it restores trust once it's gone. In the end, markets exist to allocate capital efficiently. When they're locked, they fail at their most basic purpose. When prices stop reflecting reality, when traders stop trusting the process, that isn't a minor glitch. It's a signal that the system itself is under extreme pressure. And when that pressure finally breaks, it doesn't unravel slowly, it erupts all at once. What many dismiss as a commodity quirk or a market anomaly is in fact something far more serious. This isn't silver misbehaving or markets losing their minds. This is money itself losing credibility. Strip away the noise, and what you're witnessing is a currency crisis disguised as a market story. In a sound monetary system, prices move steadily, purchasing power holds, and markets don't need constant intervention. But when currencies are abused, printed in excess, backed by debt instead of productivity, and defended by narrative instead of discipline, the damage builds quietly until confidence cracks. Hard assets don't spike because they suddenly became more useful. They spike because the currency measuring them is deteriorating. Silver, gold, and other tangible assets act as thermometers, registering the fever in the monetary system. Suppressing those signals doesn't cure the illness, it only hides the symptoms. For years, people were told inflation was temporary, manageable, even beneficial. They were urged to trust central planners to fine-tune the economy with rates and liquidity. But crises don't start with panic. They start with complacency. They begin when discipline is abandoned for convenience, when printing money becomes easier than making hard choices. As confidence erodes, people instinctively move toward what's real. That's not speculation, it's survival. A currency crisis doesn't need hyperinflation to be real. It only requires a growing belief that money will buy less tomorrow than it does today. Once that belief takes hold, behavior shifts. Saving feels pointless, debt looks attractive, and real assets become safe havens. Authorities often blame markets instead of policy, framing volatility as a problem to be suppressed rather than a truth to be heard. But volatility is the language of reality pushing back against years of artificial calm. Attempts to mute it only confirm what investors already suspect, that the currency is weaker than claimed. A true currency crisis isn't defined solely by collapsing exchange rates. It's defined by lost trust. When people stop believing money will preserve value, they stop measuring wealth in currency terms. They measure it in ounces, acres, barrels, and hours of labor. That shift begins subtly, then suddenly, and by the time it's obvious, the damage is already done. What makes this moment especially dangerous is the scale of imbalance. Never before has so much debt relied on such low rates and blind faith in central banks. The system assumes stability can be engineered forever. But stability built on intervention is fragile. It lasts only as long as no one questions it. Once markets begin doubting currency, every price becomes suspect. Stocks rise not because companies are stronger, but because money is cheaper. Assets inflate not from growth, but from delusion. Eventually, that delusion shows up in daily life. Wages stagnate, costs climb, and denial collapses. Currency crises unfold in stages: denial, distortion, control, and finally repricing. Each stage feels manageable until it isn't. By the time repricing is visible, the chance to prepare is gone. What's happening now isn't chaos, it's consequence. Years of monetary excess colliding with reality. Markets aren't irrational. They're finally being honest. This isn't about silver or volatility, it's about money losing its anchor. And once trust in currency is broken, no speech, no rule, no intervention can restore it overnight. Confidence, once lost, is slow to return. That's why those paying attention aren't panicking. They're repositioning. They know this was never about markets spinning out of control. It was always about currencies doing what history shows they do when discipline disappears. So ask yourself, if everything is fine, why are markets being frozen? Why is price discovery suspended? Why does silver need daily emergency breaks? Because this isn't about silver anymore. It's about trust. It's about currency. It's about a financial system that only works until it doesn't. And when markets lock, The message is clear. Step away from paper, step into reality. Because when the doors reopen, prices won't wait.